welcome to the stream.
Boom. What's going on? Great to finally have you.
Nice. Took some. What's going on? Let's
Uh,
go.
I was
I
just
had my
saying,
I had my caffeine already, so that's why I'm like,
good.
Fantastic.
Good. Somebody was commenting yesterday about our caffeine consumption, and I was like, yeah, it's easily 500 milligrams plus at this point. John, that's 500 milligrams during the show oftentimes, but he's like built like a horse, so he can take it. How are you doing? We were just joking about whether or not you had slept at all the last week. I know it's been busy. I'm sure it's been a busy time for you and the whole team.
it's been busy, but our systems have been up at least compared to other folks. So
That's great.
Yeah, that's good. Walk us through some. I mean, I'm mostly curious to hear you had shared on X yesterday about how there had been more buyers than sellers over, at least in certain moments over the last week. Maybe break down that data point and then we can talk about some other stuff that's top of mind.
Yeah, I mean, generally speaking, just to like immediate step back is like this generation of investors, like call it especially millennials, like man, they have been through market cycles like crazy in the past 5 years, right? And or even just like through their lifetime. And I even saw some meme on X the other day of like millennials experiencing the fourth once in a lifetime opportunity of a drop in the market, and so on. And I think especially like the March 2020 drop where like circuit breakers hit and so on is still in people's minds. And I think that specifically because you saw a lot of like individual investors actually also making money on that. And I think that has stuck with a lot of people. And so generally speaking, this behavior of buying the dip is a little bit retail investing culture now. And so whenever you see these like massive drops, this is really when we see some of our best days.
Yeah. My
so
reaction
yesterday was like, one of our record days in just deposits, for example. And
my reaction, the stock market was down 5% back-to-back days. And I was just like, what is everyone complaining about? We're not even hitting circuit breakers. Like this is not that crazy to me because I remember 2020 and it was way crazier. But of course, like it's very serious.
Can you actually break down the mechanics of what it what exactly is happening and what truly triggers the circuit break?
Yeah. I don't have the exact numbers in front of me, but it's essentially just if it drops too quickly to specific thresholds. I believe it's 7% and then 10 and 15 or so. Essentially, they pause the markets, and that didn't used to exist in the past, right?
Yep.
And so it's essentially like a little bit of like a safety trigger, like a speed bump to make sure that investors can take a breather when these markets start to drop too quickly.
Yeah, in Japan, don't they have lunch break in the middle of the
They do, not just in Japan, other countries too,
Other countries too, I love that. But yeah, it makes sense. I mean, a couple of years ago when the algorithmic trading got really popular, there was like the flash crash. I think the market traded down like 20% in like 2 seconds and then went back up. And yeah, obviously you want to avoid that. What about overnight trading? You always hear, oh, you're watching the futures market, and it seems like somebody has an edge here that they can trade before the market opens. How is 24/7 trading coming to America? We've heard some rumors. Is there a way to get in on that action?
Generally speaking, I think it's definitely coming. Like it will also come to public at some point. Right now, we essentially have 4 a.m. to 8 p.m. But the thing that you have to think of is that each trading window has its own participants and its own liquidity and execution venues. And so think of it as like there's the regular opening between your 9:30 and 4 p.m. That's the most liquidity. It's when like most people participate. You could call that the healthiest time in the market in theory. Then you have essentially pre-market and post-market, which is 4 a.m. to 9:30 and 4:30 to 8 p.m. And then you have overnight, which is like the new thing. Overnight right now, there's essentially only like one major player who drives the liquidity for that. And what happens there is that because you have only one player, you have a lot of you have not as many platforms participating yet. And so you can have these moments where there's a lot of kind of unilateral flow happening. And that's why in the overnight markets, you often see certain stocks just suddenly rally or so on. And that is a little bit, I don't want to call it fake, but it's a little bit like it has these wild swings because the types of people that trade in those times of the market, and it's a concentrated liquidity pool. And so these swings just happen, way more dramatically. And so you often have these moments where like in overnight, a stock goes up and you see on Twitter, everyone's like, I'm sorry, on X, everyone like posting the screenshots of like, oh my God, Palantir is going nuts right now, or whatever the company might be. And then suddenly like 9:30 market opens and it goes, whoomph, goes down and everything kind of normalizes again, right? And that is really just because each market window has their own participants and their own pools of liquidity. And so you kind of have to take it a little bit with a grain of salt. Like, can you play that? Maybe, but there's obviously some risk there as well.
Can you talk a little bit about information diets? And really, I want to know what events that are predictable, not like Trump imposing massive tariffs all of a sudden on Liberation Day, but what can we count on like clockwork every single day to be the highest volume day of the year? Is there a Super Bowl of stock trading that happens, whether it's earnings day or jobs day? What are the big reliable sources of high liquidity in the market?
I don't know if I have a good answer there. My gut reaction would be just from internal measures like Monday mornings, because you have a lot of queued orders from the weekend and stuff like that.
Yeah, makes sense.
You get executed at the open.
Okay.
Because not everyone will trade pre-market and stuff because spreads are wider and all these things.
Sure.
But specific days, not really sure, to be honest.
Maybe like big tech earnings too is kind of like a season for
that. But generally speaking, exactly, like it's always like it's often just driven by market events, right? And at the end of the day, people will trade when they see opportunity.
Yep.
And if you can predict that, let's start a hedge fund together tomorrow. But other than that, it's like it is driven by these moments, right?
Yeah.
And whenever, like, we have good days when the markets are in the news, no matter which direction. But as long as the markets are in the news, we have good days because people get inspired one way or the other.
Yeah.
And so in a way, trading volumes for companies like ours are a little bit like competing with any other thing that competes with attention. Yeah. Because if markets are in the news, you get inspired by something, and that might drive action, and that's what we see.
Yeah.
What do you see from a demographic standpoint? I'm curious. So public obviously offers access to bonds, which it was probably good to be in bonds. If you sold last week before Liberation Day, but do you see a lot of demographic differences? Sort of like Gen Zs, basically like. Bonds for me are just like GameStop, right? Like I always know it's gonna be worth something.
Yeah, it's a store of value.
Yeah, it's a store of value, right? Yeah. But I'm curious if you see sort of pretty specific activity across different demographics in terms of interest in these different types of assets.
Yeah, I mean, straight up bonds always skew older, just from the perspective of the older you get, the more you're like thinking of preservation versus growth. But then I think what's interesting now is that, so we've launched multiple yield accounts essentially. So you have your high yield cash, which is, similar to a savings account. You just get your yield and it's variable based on interest rates and such. Then you have like your bond account, which is essentially like a basket of corporate bonds underlying. And then you have like your treasury account, which is like US government treasuries. And those kind of simplify the investments into bonds because you just deposit money, earn yield. It's like very simplified and just like, you don't have to like pick certain bonds and stuff like that. So what we've seen is with that is that a lot of people are using those to just put money into the markets, waiting for these moments of opportunity, right? So what we see in the last few trading days essentially is that people cycle out of the yield accounts and into stocks and ETFs because they essentially had this cash lying around, and we're like, okay, I think totally what we've been hearing a lot is that like, hey, after Trump was elected and the market started ripping and there were, all-time highs and a bunch of things going on all the time, that there was also a bunch of, individual investors who were essentially feeling like, oh, I'm just buying the top right now. And so they put it into these yield accounts. But then also the minute you saw things drop the way they've done now, they've basically cycled it out of the yield accounts into stocks and ETFs specifically. So you're seeing younger generations using it less as a, hey, I'm going to now actually hold the bond to maturity 10 years from now, and more use like these account types that we've created for, just like earn some yield on your stuff, until you, actually see other opportunities.
Yeah.
Do you think AI is already helping retail investors better understand the companies that they're investing in, right? Every public company is putting out a huge amount of information. Unless you're becoming just overly obsessed with a specific stock, it's hard to figure out what's important. What should I be looking at? What have you guys seen? I know you've released products to help people leverage all of that data with AI, but I'm curious what you're seeing.
That's a great layout, Jody, by the way. Thank you.
Real softball.
Straight into my pitch, Thankful sponsor.
Yeah.
But yeah, 100%. And like we obviously launched Alpha, which started off by just you can swipe down on any stock, ask any question about the stock, and and that just created this like bite-sized researching for things. And we've kind of fed the model with a bunch of data that we already had from years ago. Like for example, we acquired a company like 3-4 years ago that was essentially a tool that turned all the SEC filings that had custom company KPIs of like subscriber numbers and how many cars has Tesla shipped and things like that into more structured data, and then we use that structured data to kind of train our models and such to make that very easily accessible. What has happened is that it's much more proactive than just you kind of have to pull information. And so the obvious one is what we call why is it moving, which essentially if a stock is going in either direction very heavily, we kind of pop this card on that page and tell people, why this thing is likely moving right now. And then you can tap on that. That brings you into a conversation with Alpha, gives you more, granular breakdown on that. And so it's much more the pulling versus the, the pushing versus the pulling. And I think that's also just generally where it's going. But like what's awesome to see is that these bite-sized contextual moments where AI can be super fast, where it's just really great at summarization, and can also go against biases, right? So like if we go for news stories, for example, we sort of say that QA multiple sources. So we're not just coming from one source and pop it to you, but we QA multiple sources, and then the summarization comes from the multiple sources. And so there is a little bit of like QA built in, and a little bit of like taking the bias out that maybe one writer will have or something, right?
Yeah.
Which can be helpful.
Speaking of data quality, what do you think? Yesterday Walter Bloomberg shared some news that wasn't quite accurate. It moved the market, trillions of dollars. Maybe helped us avoid whatever it was, Black Monday. Kramer was calling it. What do you think is? Do you think that there's any like solution to that, or it's just the nature of the internet where now you have these accounts that basically they're basically like mainstream media, except they just publish headlines. They're not doing any journalism. They're not even looking at data. They're just sort of like trying to be the first or second or third big account that's like sharing a headline. What's the fix there, right? Is there one, or is that just the nature of the internet where this sort of information breaks and then markets are going to react really quickly? And now retail investors are so ready to act on information. A good example is like if you just happen to be on X when Trump posted Trump coin and bought 20 grand of it, you became, a millionaire within a few hours. But I'm curious, like if you've thought at all about like how, I don't know if there is a solution, right?
But I think we always come back to, who are you building for, and therefore what behavior is your product inspiring? And and generally speaking, the way you design your product will always have an impact on how people use it and their behavior. And in our case, you can buy a meme coin, you can do options trades, but generally speaking, the way we've designed the product and the offerings that we have are more focused around building long-term portfolios for people that want to, compound their wealth over time, all the fixed yield, the fixed income offerings that we now have, et cetera. And I think there are just certain design decisions that impact in the end the behavior of of these users, right? And therefore, in the end, I think that is much more important for people to make healthy investment decisions than necessarily, like how they consume and so on. But like that behavior you're talking about is obviously not necessarily coming from the potential wrong information from some X account. That behavior is more cultural, or how they were trained when they started being in the markets, And so I think that is much more the sense of like, if the platform you're using is closer to gambling, you will end up being more of a gambler automatically, just based on the design of how you were introduced to the markets, and therefore you'll be more prone to potentially react on these types of things, because your investing style will be closer to a gambler than maybe someone who tries to compound their wealth over time and is cycling money out of a hiker account into Amazon stock or whatever because they see an opportunity that to then also hold it for long term and so on. So I think that's much more the issue, so to say, than those accounts.
I have a bunch of other questions, but I think we're over. We'll have to have you back on very soon. I know you got some big stuff in the works. Thanks for coming on.
Yeah, I'm excited for the announcements. This will be great. We'll talk to you soon.
You're the man.
Bye.
See ya.